You're a small business owner, you already understand cash flow, risk management, operations. So why not apply this to real estate investing? The truth is that real estate can add financial stability beyond your business. It can help reduce your taxes and it can increase your overall wealth. In this video, I'm going to break down the benefits, risks, and the simple steps that you can take to buy your first real estate investment the right way. I'm James Masotti, a real estate investor, the owner of our team accounting and Crystal Clear Property Management. And on this channel, I'm passionate about helping business owners achieve their personal and professional goals through intentional financial planning. So let's go ahead and jump right into today's video. To kick things off, we're going to talk about the key benefits that investing in real estate bring to small business owners. The first is a potential stable and reliable source of cash flow. So business income, depending on the type of business that you have, isn't always super predictable. It can fluctuate month to month or season to season, depending on the seasonality of your business or if it's reliant on certain sectors of the economy. People generally are always going to need a place to live, and therefore you're almost always going to have your rents being paid every single month. Now, it is important to understand the fact that tenants do sometimes pay late. And sometimes they don't pay at all. And that can, in fact, lead to evictions. So as though this is a benefit, it is important to check resources like evictionlab.org in order to kind of get a sense for what the eviction rate in a particular market that you're looking at investing in is going to be, so that you can get a good sense for how predictable and how reliable the income's going to be if you're investing in that particular area. The next benefit is tax advantages. And this is one that you hear about a lot with regards to real estate. And the caveat to this is that these are very common strategies that a lot of business owners going to utilize, but they can't be utilized all the time. Sometimes it only makes sense to utilize them in specific property classes. And so it's really important that you have a conversation with your tax planner or your tax strategist in order to figure out which of these scenarios are applicable to your situation, or maybe if there's other less common scenarios that are actually better suited for you in terms of how you're going to look at your overall tax plan and tax strategy, given what your personal and professional goals actually are. The first thing is depreciation. And this is probably the most common and standard real estate benefit that everybody's aware of. If you own your own home, then you're already familiar with taking the depreciation expense on your taxes. And there's no different in being able to do that for your investment properties as well. If, however, you own larger real estate, whether that be commercial or industrial space, maybe it's a multifamily property or anything generally that would not be considered like a single family home, then you could actually potentially accelerate your depreciation on the particular property by doing what's known as a cost segregation study. Now, this cost segregation study does cost quite a bit of money to do, so that's why it's often not done on smaller, less valuable properties. But basically what it's going to do is break down the building into all of its individual component pieces, which oftentimes can be depreciated more rapidly than the overall real estate asset itself can be based on the standard IRS guidelines. Now, one thing that is important to know is that when you depreciate your property, then whether it's through standard depreciation or through a cost segregation study, is simply the fact that whenever you do eventually exit the property, you have what's going to be called depreciation recapture, and you will eventually have to pay taxes on that. So the important piece of this tax strategy is understanding that it will help free up your cash flow for reinvestments in the near term, but you do need to have a plan for how you're ultimately going to pay the depreciation back when you eventually have your capital gains event when you exit the property. Speaking of exiting the property, one of the great ways to kick the can down the road on having to pay those taxes is by doing a 1031 like-kind exchange. There's a specific code within the IRS tax code that allows you to take one asset that you have been holding on to, and basically when you sell that, be able to take the proceeds of that and buy a like or similar asset of greater value, so that you basically are effectively like trading up. And the way to think about this in a simple example is in everybody's favorite real estate board game of Monopoly, is taking your individual houses and upgrading those into hotels. And you're basically able to do that in real life by utilizing a 1031 exchange and not having to pay taxes on the sale of the property. Now, when you do this, it's very important to make sure that you understand there are very strict rules around how you can do a 1031 exchange. So again, if this is something that you're interested in, first have a conversation with your tax planner to make sure that it aligns with your overall tax strategy. And then you're also going to have to explore getting a 1031 intermediary who will help you make sure that you are following all of the proper steps for being able to execute on your plan. The next benefit to owning real estate is the fact that you're going to be building equity in an asset for the long term. And while real estate over time has appreciated for the most part, there have been windows in the recent past where values of real estate have gone down. So it's important to understand that when we talk about building equity and things along those lines, that you don't want to necessarily always bank on any smaller window of time your property value going up. That being said, when you look at over the entire history of time, just because of inflation, if nothing else, the value of properties are generally going to go up. And what's going to create our equity is the fact that we've got a mortgage on that property that was based on the purchase price that we had at the time, and we are going to be paying that loan balance down. As we create a delta between what our property is worth and what the loan balance remaining on that property, that represents our available equity that if we eventually sell the property, we can convert that to cash. So while it's not near term or necessarily easily liquid, because if you're trying to sell a property, maybe that's in a less desirable area or in a more rural space, or that has a special functionality to the type of building that it is, or the zoning is maybe something that needs to be reclassified. There's a lot of reasons why selling property can sometimes take quite a bit of time to actually go ahead and execute, depending on what it is. If you're trying to sell a manufacturing site, a lot of times you have to do environmental studies. There may have to be some remediation that gets done. And there's all these different kind of components that ultimately go into being able to sell that asset in order to be able to capture the equity that you've ultimately built. One of the other big benefits of owning real estate is simply the fact that your business is going to have to pay to operate from somewhere. So why not pay that money to yourself, right? So you can be paying rent to your landlord, and that's money that basically just gets flushed down the toilet that you're never going to see again. Versus if you're paying that money to yourself, you're paying down the debt on an asset that you actually own. So one of the things to look at, and a lot of people will take into consideration, is their return on their equity. So as you put money onto that, how do you make sure that your business isn't basically having all of its assets tied up in a particular asset, in this case, the real estate that your business sits on. And so that is something to take into consideration. But through cash out refinances and lines of credit, there are ways to tap into that equity in order to get cash back into your business for additional reinvestment purposes and things along those lines that allow you to continue to own the real estate and operate the real estate without necessarily, having to have a sale event. Most frequently, you're also going to hear the suggestion and the advice that you keep your real estate in a separate entity, oftentimes an LLC, than whatever your business is. And there's really kind of two primary reasons for this. One is the fact that you want to separate your liabilities. And so if you have a great asset in your business, like real estate with lots of equity in it, and for whatever reason your business gets sued, then your business has a lot of equity available that somebody selling you could actually go after and, force you to sell that asset in order to pay, what's needed from a lawsuit. If, however, the business is in one entity and the real estate is owned in another entity, you've isolated your liabilities and not created any issues necessarily from that perspective. Another reason is simply the fact that it gives you options to be able to sell the business without the real estate, or the ability to sell the real estate without the business. If those are owned together, sometimes it can be a little more difficult to untangle those two things if they have consolidated financials where everything is mixed together. One of the things that real estate does really, really good at is it helps you get wealthy in a very slow and reliable way. Like it's the old, the tortoise is going to win the race, not the hare kind of scenario. And so real estate is a great play if you're trying to think about, your long-term, like retirement planning, because, you basically can be living off of your business, but as an active source of income, that is, when you stop working, unless your business grows to a size where you can remove yourself from the business and you have employees who can continue operating the business and you can continue getting your dividends as the business owner without actually paying yourself a salary for working in the business, then you've got that. But if it comes to a point where you either need to shut the business down and walk away, or if you eventually need to sell the business and have an exit, if you've been investing in real estate for 20, 30 plus years, there's a pretty good chance that you now have a piece of an asset that is potentially free and clear. And so all of the rent that's coming in, instead of going towards paying a mortgage for the rest of eternity, will basically be able to pay you and whoever inherits the properties when you pass along. All right, so next we're going to be talking about some of the key risks to take into consideration when you're getting into your real estate investing. One of those key risks is getting overextended financially. What this realistically means is that you're taking on more debt than what your cash flow is going to really allow you to be able to do. And this comes from being able to understand how to scope out and plan your projects and your project timelines. So if you're buying a property, for example, that is needing to be repositioned, maybe it has an existing tenant that needs to be evicted and then also needs rehab work. And as you buy the property, you are going to have carrying costs that come with that. So whether you're paying all your own cash or you've taken out some sort of a loan, not fully understanding the cost of the eviction, the amount of time that'll take, or the full cost of the rehab and how long it'll take to get the property fully rented back out after the work has been done, can ultimately eat significantly into your cash flows and then really impact your ability to have a functioning portfolio of real estate, even if it's just a portfolio of one property. And getting overextended like this on a cash basis can really hurt you. Even if in theory your portfolio has equity available in it, you might be forced to be in a fire sale situation where you got to quick get out of it simply because you can't afford the ongoing monthly expenses any longer. One of the next risks that you can encounter when dealing with real estate investing is market fluctuations. And while generally speaking, you'll hear people talk about real estate values always go up, this is the case on a long-term horizon, or at least has been for the last couple hundred years. Obviously, what we experienced, however, in, for example, the 2008 housing crisis, is there are periods of time and economic events that can cause for short-term disruption in housing prices. So if your strategy is really evolved around having your rents always going up and the value of your property always going up, then you do run the risk of having these market timing influences really having an impact on your ability to generate returns. While this isn't necessarily the case for rental properties as much, it is definitely an issue if you are trying to flip houses, for example, because you're buying it at a particular price and you're expecting to be able to sell it at another price higher than that down the road for a profit. So in the event that the market doesn't appreciate as much as you think it does, or maybe it even goes down, you might be at risk there. But you're not entirely insulated from risk if you have rental properties either, because if you're doing a scenario like the BRRRR scenario where you're trying to renovate and then get a tenant into the property and then refinance out of it, if the market value of the property when you're trying to do that refinance portion has again dropped, then there is a chance that you are not going to be able to pull as much of your money back out of it. And if you have loans that you have to pay off and you're unable to pay those off with what you pull out of it, then you're going to have to come up with that money from somewhere else. So as a result of this, we really want to encourage you to do your underwriting more conservatively, especially in the beginning when you're just getting started, unless you have significant cash reserves that you're willing to tap into in the event that you have expensive mistakes and learning experiences that you're going through. So by focusing on your cash flow and being able to focus on more conservative numbers, maybe not maxing out how much rent you think you're going to get for a property, or if you're looking at the market and you feel like the market's been going up, maybe plan for a appraisal value or an exit sale that's not at the top of the market, but rather at the current market price or maybe even slightly below that market price, so that if the numbers work out there, you have a lot more downward protection and more potential upside if the market actually swings in your favor. Another risk that a lot of people don't fully understand when getting into rental properties in particular is the headaches and the frustrations that can come along with property management. Now, most people who manage their own properties will tell you that they don't often get those 2 a.m. phone calls from tenants that their toilet is not working. If you think about your own home, that doesn't really happen all that frequently. And so it's not likely to happen in your rental properties either. That being said, you need to have a process and a system for being able to field those calls and quickly get people out to be able to take care of them. Along the same lines, part of property management is going to be dealing with screening tenants and dealing with neighbor issues and issues with trash and who's fixing this or fixing that, and potentially even having to deal with evictions. And so kind of understanding your own intestinal fortitude for being able to deal with these kinds of scenarios and situations is something that a lot of people don't necessarily reflect on before they jump into rental property investing. If you're not sure and you think you're going to be able to handle it, just understand that you could get started. And if you realize it's not for you, you always have the ability to sell the properties off in the future and then move forward with a different investment strategy. So this isn't something that you can't get back from or you can't step away from if you realize property management's not for you. But it's also one of the key reasons why, regardless of what you're planning to do, we always encourage investors to make sure that they are baking in a property management fee into their numbers. So whether it's understanding from a flip perspective, if you can't sell that flip, then you may need to keep it as a rental, and does it support property management fees? Another thing to understand with real estate investing is that compared to some other assets like the stock market or maybe even some CDs or money market accounts, is that your real estate is a little less liquid, right? When you have tenants in them, and if you quickly need to get access to cash, being able to sell the property or even get a line of credit can take you several months of the process to be able to do. If sending your tenant a non-renewal notice, if they're on a year-long lease, you may have to wait until the end of their lease to be able to do that. But even if they're on month to month, for example, in Delaware, where my properties are, I still have to provide a 60-day notice to the tenant to be able to move out. And then even after that, if they don't move out, you would still be required to go through the eviction process. And so you would either be forced to go through all of that and not be able to sell until a future date, or you'd have to sell it with a tenant in place. And there's just a smaller buyer pool with a tenant in place because you're basically only going to be selling to an investor at that point in time. One of the biggest mistakes that I probably see newer real estate investors making, and this is honestly a lie that is propagated by a lot of popular TV shows when they talk about, how to run the numbers, and even a lot of real estate agents who are themselves not investors and don't actually know how to run analysis on real estate investing would go, is there's this idea of, hey, I have a mortgage payment of $1,000 a month, and I'm using easy numbers. And my rent is going to be $2,000 a month. And because of that, I'm going to have my property taxes, which are maybe $400 or $500 a month. And then I have my insurance, which is a couple $100 a month. And as a result, after all of that sort of stuff, I'm going to be making $300 or $400 a month. And I'm going to have great cash flow coming out of this property. Well, in actuality, you're probably losing money on that particular deal. And the reason for that is all of the other expenses that you're not taking into consideration. And what those expenses are physical or economic vacancies. So periods of time when a tenant leaves and you may be waiting for a new tenant to move in, or when you have a tenant who decides to stop paying their rent, either intentionally or maybe due to a job loss, they're no longer able to, or whatever the situation might be. You have to have enough money coming in to cover the periods of time where that person is not making their payments, but you still have to pay your bills on the property. And this is one of the critical components that a lot of investors forget about, is you need to be accumulating this cash and you need to not be spending it. You need to have a separate account that you're able to build up these reserve funds into so that you can draw from those when you need them. And what a lot of people get confused by is they see that maybe $200, $300, $400 a month accumulating, and they start withdrawing that money thinking that's cash flow that they have. And this problem is one that can compound as you build a portfolio. If you're thinking that you're going to have these several $100s a month every month coming in, and you're growing your portfolio off of that because maybe you've been lucky and you've been able to defer some of those expenses, they're eventually going to catch up to you, and you're not going to have the cash to be able to upkeep your properties. And so this is a significant problem that a lot of investors will encounter. So now that we've gone over the risks to owning real estate, we're going to start going through the step-by-steps that you can take in order to get started on a real estate investing journey. So I would say the first step with regards to figuring out getting started in real estate investing is simply understanding what kind of real estate investing strategy do you actually want to do. There's a lot of different ways to invest in real estate, from more active types of real estate investing. I might actually consider these to be jobs in the real estate field, like being an agent or being a flipper or a wholesaler, for example, versus maybe things that would be considered more passive in real estate investing, like buying residential rental properties or using what might be referred to as the BRRRR method. The buy, rehab, rent, refinance, repeat is another way of buying rental properties outside of the conventional putting like 20 or 25% down to buy a rental property. Then you also have things like being able to do short-term or mid-term rentals as another example. You have the ability to get into larger scale deals like apartments or industrial and commercial buildings. And to do those, if you don't have significant amounts of capital, you may have to go through an SEC registration process of what's called a syndication of raising capital from accredited investors. And that's a whole nother avenue. If you are an accredited investor, you may simply choose to invest in other people's deals rather than go chase down all of these deals yourself. Then there's another form of real estate investing, which is buying notes. And one of the cool things about buying notes is that you basically are becoming the bank for somebody who does own their property. So you're going to be getting those monthly payments just like you would if you owned a rental property, but because you don't actually own the rental property and they're not your tenants, they own the property and it's theirs, you don't have to deal with any of the other properties or other issues that come up, right? You don't have toilets to fix or anything along those lines. Then there's things like land investing and other like hybrid approaches where you have self-storage, you have things like mobile home parks and RV parks and things like that, which are kind of a hybrid of buying a business as well as owning real estate, kind of combination of things. And so understanding kind of what strategy and what form of real estate is most appealing to you is really a great place to get started on this journey. So once you've identified what kind of a strategy that you want to do, now you want to go start researching the markets where you think you would be interested in investing and or identify markets you'd be willing to invest in. Market data is really important because while real estate has a lot of macro trends, there are a lot of different components to individual markets that can be driving your real estate investing. So whether that's, there are certain states that right now are seeing massive population increases and booming housing, whereas other states have more stabilized housing markets and some that are even starting to shrink because of people fleeing those states for a variety of different reasons. Within states, though, you also have different geographic areas. So are people moving into the major cities or are they moving away from the cities into suburban areas? And from there, you also have to look at inside of the cities, what neighborhoods are growing or expanding, going through gentrification, and are there neighborhoods that you really don't want to be a part of because of, they're not likely to have the types of real estate and the types of tenants that you're most interested in engaging with. Being able to understand those population trends, being able to understand what's going on with the local economy. Are businesses coming to that state or are they going away from that state? Is the population increasing or is it decreasing? How about evictions? What does the eviction situation look like? There are some states where it's very easy to get an eviction and you could have somebody out of a property within maybe a month or two. And then there's states where your eviction process could take many, many months to get somebody out of that. Along those lines is understanding the landlord-tenant laws, in your state or the state where you're planning to invest. And whether that's residential or commercial, some states have no commercial landlord-tenant laws, and it's all basically viewed as business contract law. Whereas there's states that have considered to be very tenant favorable, and then there's states that are considered to be very landlord favorable, and then a spectrum of folks that fall in between there. And so understanding how all of these different dynamics of the market are going to impact your ability to be able to execute the form of real estate investing that you're interested in is important to understand as well. I would say the next piece of the puzzle that you're going to want to take care of is getting your personal finances in order. Regardless of what form of real estate investing that you're going to want to do, banks are generally going to want to see that you have good credit and that you have some liquidity of cash available to you. So if you don't already have a credit score that's in the 650 or 680 and above, I would say you definitely want to be working on your credit situation for yourself, or find a business partner who has better credit worthiness that you can rely on when working with banks. Additionally, if you are looking at wanting to go kind of more of a traditional acquisition route, then you're going to need to have something between 15 and 30% of your target purchase price saved up in cash, as well as making sure that you have additional emergency funds for, hey, you buy the property and on the first day you need to replace something that you didn't anticipate. You need to make sure you have access to cash. So whether that comes in the form of cash sitting in a bank, or whether it's a willingness and understanding to put it on credit cards, and you're comfortable and good at managing your debt levels to your income level, these are all important things to make sure that you kind of have all the pieces of your personal financials in place. Now that you've got your personal finances in order, the fourth step of the process is going to be identifying how you're going to go about getting financing for the properties. I'm going to guess that most people watching this video aren't sitting on hundreds of thousands of dollars of cash, and they're planning to just go ahead and buy a property in cash and then never refinance and pull any of their money back out. There may be people out there that do that, but that's certainly not how most people are going about the real estate investing. So with this in mind, you're going to want to think about, do you want to buy properties in your personal name, or are you going to be buying them in your existing business? Or does it make sense to set up a separate entity specifically for buying your properties? This is going to matter because it changes what options that you have available to you. If you're buying in your personal name, then you're going to be dealing with a residential loan product that has some potentially more favorable loan terms of lower interest rates and longer terms and amortization cycles. But oftentimes you're dealing with banks that are going to be getting those loans backed by Fannie Mae and Freddie Mac. And depending on situations, there's somewhere between 4 and 10 properties that you're able to purchase before you're tapped out with that approach. There's also a liability concern that you want to give into consideration. And so if you go that route, I strongly recommend that you look into a personal umbrella policy to protect the rest of the assets that you have from being accessed in the event that you're sued. If you're buying a property inside of your existing business, then you potentially have the option of looking at the SBA 504 plan. If you are occupying more than 51% of the piece of real estate that you're purchasing, you can get really great and favorable terms from the SBA on low down payment and long amortization periods, which can be really a great way to be able to buy a property. Again, you have to be in 51% of it, but then you have the ability to rent out or sublease different portions of it to other folks and improve some of the cash flow while also taking advantage of the benefits of owning real estate. If you go ahead and you decide to have a specific entity created, most people are going to be advised to set up an LLC for the purposes of purchasing real estate. You're going to be dealing with commercial financing at this point. And with commercial financing, you're most likely going to end up dealing with like small local community banks or credit unions, because as I mentioned previously, real estate is a very local kind of thing. So unless you're dealing with larger, more expensive multifamily or industrial residential type properties, you're most likely not going to be getting a loan from Bank of America or Citigroup or US Bank or any of these other big, large national lenders. Well, they'll tell you that they have these, local lending programs and things along those lines. More often than not, they're lending to those large institutional size folks. And it's really those community banks, those credit unions that know the local community, and they do those loans in those local communities because they have their own internal credit teams, and they also tend to hold those loans on the bank's balance sheet. And so because they do that and they're not necessarily looking to sell those into any sort of secondary markets, they have a much stronger understanding and commitment to making sure that they're partnering with the right people who are going to make the right investments into the local community. There's also a scenario if you're looking to be purchasing off-market properties, whether that's from wholesalers, you're buying them direct from the homeowners themselves through your own marketing initiatives. If you're going to be buying at auction or foreclosure sales, then you're also going to want to be building out a network of private lenders or hard money lenders that you're going to be able to get short-term loans from in order to execute those purchases before you then go get permanent financing with the local bank or credit union that you're going to be working with. The fifth step in this process is going to be to start building out your real estate team. So real estate is one of those things that is almost impossible to do everything on your own. For example, if you are buying or selling, there's a good chance that you're going to want to have a real estate agent help you with that particular process. Even if you're buying directly from homeowners or from wholesalers and you're not using a real estate agent, then there's a pretty good chance that you're also going to need a real estate attorney or a title company in order to help you make sure that you're doing the closing and that you're recording all of the proper paperwork and things along those lines with the deeds office and mortgages are being recorded properly, and that you're doing all the title searches to make sure you can legally purchase that particular property. From there, you're also going to make sure that you need insurance for your property. And there's different types of insurance, again, depending on what type of entity you're buying it in and whether you're flipping a property or you're going to be holding it as a rental, and making sure that you have a insurance agent who is going to be able to provide you the proper coverage that you need. And of course, lastly, you're going to need to make sure that you're properly accounting for all of the financials that are going on. So whether you're planning to do your own accounting, I really make sure that you are doing your accounting in a way that allows you to see if the profitability of all of your projects, of all of your properties individually, and that you're properly allocating all of your costs to all of those. Like any other business, you want to make sure you know where you're making money and where you're losing money, and make sure you have proper financials is really going to be the way to do that. And so you may be starting off doing your own accounting, but as you grow, that might be something that you eventually want to look for an accounting partner like our team accounting, where we can take care of handling all of that stuff for you. So now that you've been doing your research and you're finding a team that's going to help you with all of those different aspects of things, the next thing to do is the fun part. It's actually go out and buy a property. So to buy a property, you want to make sure that you're doing your due diligence, that you are properly underwriting all of these deals, that you're really, pressure testing, how much renovation work they need, what are the ARVs, what's the market rent value, and all of that sort of stuff. And there's a pretty good chance that, whatever properties are being listed for, either on the MLS or, at auction, or if you're trying to negotiate directly with a seller for an off-market deal, their initial prices may not make sense. And you need to feel comfortable making offers and understanding that you're going to get a lot more no's than you are going to be getting yeses. And that's how you ultimately are able to find the deals that you need to get done. So now that you've bought a property, whether you're going to be flipping that property or you want to turn it into a rental, you want to assess what kind of repairs that particular property is going to need in order to not only be able to maximize your rents, but also minimize your repair costs. For example, we first and foremost always want to make sure that we're taking care of any sort of safety issues. So if you're buying a property that has, damage from wood destroying insects, or from, if there's any sort of like fire or flood issues, you definitely want to make sure that you're remediating any mold issues, you're remediating any flooding or any, structural issues from, as I mentioned, termites or, things along those lines, or foundation issues. You definitely want to make sure that you're properly taking care of those, that you're getting all the proper permits and engineering stamps and certifications to handle those things, because we're really talking about the people's lives when it comes to those types of repairs. From then, you want to go taking a look at, what's really going to maximize your ability to get the best return for the bang for your buck. So this is when we start thinking about things like, are you going to remodel bathrooms or kitchens, replace windows, replace a roof? All of those things are easier to be done when a property is vacant than to have to deal with making those repairs when somebody's living there and they've got all their stuff that's in your way. And so while they may need to be done eventually, you really want to give consideration to, hey, are these things that I should be doing now, given the budget that I have in place? Or is that something that potentially can wait? And this goes back to the point that we talked about, is making sure that you understand what all of those numbers are. And so even if you're not budgeting to be able to fix those immediately when you buy the property, you do need to make sure that you have line of sight to, hey, I'm going to need to replace that in 1 year, 3 years, 5 years time, so that you make sure that you have either reserves set aside initially, or that you're accumulating those reserves as you are, collecting your rents, and then not spending that money on other things because you need it to spend when that repair needs to be made. The last piece is anything that's really going to be cosmetic and going to just drive the value of the property up if you're going to be selling it as a flip, or if you're going to be trying to increase the maximum appraisal value for being able to do a refinance when you do eventually pull the money out. Generally, the level of rehab, renovations and trim and all of that sort of stuff that you do on a property is also going to make it easier for you to rent out a property in that particular neighborhood. So you don't have to go all the way to the top end of the market, but as long as you have one of the nicer properties around, then that's going to significantly attract the best quality tenants, and it's going to allow you to minimize your vacancies when you do have those. So in building our team, we already talked about the fact that one of those folks that you're going to need is to find a property manager. So you're going to need to make the decision of whether you're going to hire yourself as the property manager, or you're going to hire a third-party company to be the property manager. Regardless of what you do, understand that in most markets, you're paying somewhere between 8 and 12% of your rent. And you're just going to need to make some calls, shop around, and I highly recommend that you join potentially your local real estate investment groups. You often hear those referred to as REIAs, REIA, Real Estate Investment Association, or sometimes there's even local Facebook groups, or you can find groups on meetup.com that are meeting and get to know the folks in the local areas and who they're utilizing for property management services and what they like and dislike about those folks. So now that you've got a property manager hired, the whole point behind doing that is making sure you get a tenant into your property. And so this is the part where we're now going to prepare our property for listing. We're going to make sure we take lots of great pictures and write descriptions that are compliant with fair housing in order to get those things up and on to places like Zillow and other platforms that folks will go to looking for rent. You're going to want to decide if you're going to be willing to take housing choice vouchers, oftentimes called Section 8, for your particular property. There's pros and cons of dealing with that particular program in terms of having guaranteed rent, but also they have very strict guidelines that you have to adhere to in terms of property condition and maintenance that you have to make sure you're upkeeping to. So understanding kind of the implications of that. Next, you're going to want to be able to figure out how you're going to go about doing showings. So you've got that property listed. You now need to show the property. And so are you going to be available during the day? Are you only doing it in the evening, only on the weekends? Are you going to do individual showings? Are you going to do group showings? Or for example, at my property management company, Crystal Clear Property Management, we utilize a self-showing technology called Rently in order to allow our tenant prospects to register in their platform, and they're able to remotely access the properties in order to show themselves through the property. Now that you've got prospects interested, you need to figure out how you're going to collect applications for those folks and what your screening criteria are going to be when you're receiving those applications. It's very important to make sure that you create a very clear and defined rubric for how you're going to evaluate your tenants in order to make sure that you don't run afoul with any potential fair housing or your state's landlord-tenant laws in terms of what you can and cannot use when considering and evaluating a tenant's background. There are states where you're not allowed to consider their criminal background, so you want to make sure that you're not running a criminal check if you live in one of those states. Likewise, if there are any other restrictions where you're not able to discriminate on somebody, for example, if they are smoking or not smoking or anything else along those lines, you may need to make sure that you're reviewing all of that and you have it clearly documented so that you're asking all the proper questions that you can, and then having that built into some sort of evaluation criteria to make sure you know, and you can clearly communicate why somebody was or was not approved for housing, because you will have to, in most states, provide a letter to somebody who was not approved and who did apply in terms of letting them know why they were not accepted into your property. And then once you get somebody screened, you're going to ultimately need to be able to collect rents. And so you need to be able to decide how you're going to go about doing that. One thing that I recommend that you do not do is do not go to the property and collect cash in hand. This is a great way to get yourself into a lot of trouble because you have taken on the responsibility of having to create receipts for somebody. And there's a lot of opportunity for, like he said, she said, on how you, whether you did or did not get the money. And so rather than going through that approach, if you want to be able to accept cash, there are cash pay programs that you can sign up for where they can go and pay cash at a retail establishment, and that money automatically gets deposited and they get a receipt from that company. There's lots of tools that you can use for getting paid online, where there's a tenant portal where not only can they make their payments, but maybe also submit maintenance requests and things along those lines. There's property management tools that you can utilize that incorporate a lot of that sort of stuff. Are you going to be willing to take checks or money orders? And all of these are different options that you need to understand how you're going to ultimately get paid, and sometimes what the costs of getting paid are as well. Lastly, you're going to need to make sure you're keeping up with all of the accounting for your property. Rental real estate is something that has a lot of great tax advantages. And so being able to properly document for all of your properties, your initial cost basis, all of the income that you're receiving from the properties, all of the expenses that you have per property, you're going to need to document all of this stuff at a property level, because when you do ultimately file your taxes or have a professional file your taxes, you need to be able to break all of this down property by property in order to be able to make sure that you're taking all of the right depreciations and having the right loss captures and things along those lines, so that if you ever decide to sell something, you're able to backtrack all of that on a property by property basis. So giving a little bit of foresight and thought into how you want to go about doing your property level accounting is also something that's going to be really beneficial to you, so that come tax time, you have good, clean books at a property level of detail that makes your entire process of doing your taxes really easy. Beyond just your taxes, like I mentioned, it's also going to be really helpful just to actually understand what properties are performing well or not. You can break that down by zip code or by other ways, depending on kind of like where you're investing, in order to really figure out, like any other business, like, hey, these are my properties that are good, these ones aren't. I have better luck in this neighborhood than in this neighborhood, or whatever it might be. And that allows you to kind of shape the size and scope of your portfolio over time as well. Now that we've gone over the process for how to go about buying a rental property, in our next video, we're going to be going over how you can combine buying rental property with buying businesses in order to maximize your financial future. So go ahead and click on the video on your screen, and I will see you there.